Hello traders, today is the 16th of February 2013 and the time in London it is 12:18 p.m. in New York 7:18 a.m. Happy Saturday to you all. The title of this video is how to filter out a distorted chart pattern. We have a double top chart pattern, a double bottom chart pattern, an inverted head and shoulder chart pattern, head and shoulder chart pattern. We have also round bottom chart pattern, V chart pattern. We have also Fibonacci chart patterns, and also Elliott wave chart patterns. Sometimes patterns are distorted. Now we want to know how we can filter out a distorted chart pattern. In this video, we will focus on the Fibonacci pattern, especially how we can filter out a distorted Fibonacci pattern. Let's get started. Following our guidelines to how we can recognize clearly a Fibonacci pattern, we want a price to trend first, and then we want to see a profit taking. This is our guidelines. The profit taking is what we label SA. All right. If you are new to us, we are the TSTW traders, and our website is www.stochasticmarket.com, www.dayprotraders.com, www.24elliottwave.com. So we see that the price was trending from this point to this point. That's the first guidelines. And then there was a profit taking from here to here. That's why this point we call it X for X-ray, and this point here we call it A for alpha. So price was trending, then there was a profit taking. Good. Now we want to look for our A B price move. So the price retrace back down in relation to the XA. All right. So the bear were the dominant force. Now they took profit, which means they came out of their bearish trade. Okay. We don't want 100% profit taking. This is our guidelines. If you want to recognize a valid Fibonacci pattern, we don't want 100% profit taking. Good. Now, because they are the dominant force, they will come back again to try to sell after they have taken profit. It's happening all the time. In the uptrend, you will see that the dominant force is bullish, so the price going up. All right. So the bull are dominating the market, so to speak, and then they will take profit. We don't want 100% profit taking. All right. After they have finished to take profit, they would like to buy again. All right. Now, as they are trying to buy for the second time, that's what we call AB. Now, we want to analyze the second buying, okay, to know whether the bulls, okay, are still a dominant force. Pay attention carefully. Now, you can see that the dominant force was bearish in this session. Now, they took profit here. So, in fact, they change color, so to speak. They become bulls. So, we can call this move as a bullish. But this is, in fact, the bear that was selling here taking profit. But we can call them bulls. Took over. But now, they come back again, the same bear that was dominant force, to sell here. Now, we want to analyze how strong the bearish pressure, bearish momentum is in the second selling time. Okay? So, here this is the second time they are selling. But look, they couldn't sell as much as they did in this session, telling us that the bearish momentum is weakening. So we will be thinking of a bullish, okay, Fibonacci pattern. The second time selling is what we call the AB. This point is A. At this point here, that's what we call B. All right. All right, so we'll use our Fibonacci drawing tool to measure how much profit they have taken, these bulls. In fact, a converted bear that became bull. We want to know how much profit they have taken. And using our Fibonacci retracement tool, we see that they have taken 50%, okay, profit of the move from X to A. They have taken 50% profit. The first Fibonacci pattern that's coming to our mind when we are when the second selling, in the case of a downtrend, okay, is completed is the bad pattern. The theory stated that the bad pattern, the A to B, which is this section here. Moment please. This section here to here, the A to B should be between 38.2 and 88.6% Fibonacci retracement level of XA. Here we see that the A to B has verified the theoretical criteria for the bad pattern. That's the first pattern that's coming to our mind, okay? The 50%, stop at 50%, did not exceed. The A to B should not exceed, my apology to traders, the A to B in the case of the bad pattern should not exceed 61.8% Fibonacci retracement level of the XA. Let me state this again. The theory stated that the bad pattern, the A to B, should not exceed the 61.8% of the SA. So we see now the second selling, which we label A to B, has verified, okay, the criteria for the bad pattern. That's the first pattern that's coming to our mind. Okay, now we will expect the B to C to be between 38.2 and 88.6% Fibonacci retracement level of the A to B. This move to here, that's what we call the BC. But we want to verify now whether this move from here to here is between 38.2 and 88.6% of the A to B. As you can see, it went above the 100% level. So we can say that there is a distortion in this pattern. It is not between 38.2 and 88.6%, but we have exceeded the 88.6%, even 100% level. So I will highlight this zone and say to myself, is it a distortion? I don't know, but I just want to highlight it for now, because as the price progressing, I want to highlight this level because it went above the 88.6%. So I don't know whether the bad pattern will be completed or another Fibonacci pattern will be completed. I will just highlight this level as a kind of distortion and leave it on my chart like this. All right, this is very important for a trader to be flexible and to keep eyes on the price, the number one indicator, and to go step by step without assuming anything. All I can say at this point, I can say I see a double top. That's all I can see. All right, a validation of a resistance level. But talking about a Fibonacci pattern, I will highlight this level as a kind of a distortion that has taken place, just leaving it like this for now. Okay, so I will say to myself, let's give it a benefit of the doubts. Probably it's a distorted, okay, B to C, and let's see how the C to D will be formed. According to the theory, the C to D should come down to the 88.6% Fibonacci retracement level of the SA, XA. So we will expect the C to D to end somewhere here. If you were expecting a Gartley pattern, we will say you will end in the zone of 78.6%. If you were expecting another pattern, butterfly pattern, we may say the first target zone is 1 to 7% extension of SA. But here, because the price changing direction of 50%, the first Fibonacci pattern that is coming to our mind is the bad pattern. There was a distortion here. Now you see that the C to D did not come to the 88.6%. It did not even reach the 78.6% zone of the XA. So there is no Fibonacci pattern. That's what we will say at this point in time. So there is no Fibonacci pattern here. All right. So we will remove all our drawing, but we will just start afresh again, looking at the price itself to analyze the price, the charts, and see what is happening. So all my exercise so far did not reveal to me any Fibonacci pattern. Though we have seen a double top, and there is also a double bottom here, we didn't see any Fibonacci pattern. It's becoming very interesting now. We are talking about how we can recognize a distorted chart pattern. Pay attention very carefully. Now we see that the price went up again from here to here because it displayed new higher high. So the dominant force, again, as we did here, the dominant force was bearish, and then there was a profit taking, you remember? And then we start labeling it and going step by step. We start again the same thing. All right. In fact, I will remove this one. So all I'm going to do is to draw a line, and I will see that the price went up from here to this point. Okay. And then there was a profit taking, but we don't want 100% profit taking. But look, but we have 100% profit taking. So I cannot label this one as XA. I cannot, because it's 100% profit taking. It is not. But pay attention carefully to this chart. You can see that as the price reached this level, there was a bullish engulfment. The price quickly, so this candle brought it down for 1 month, and the second candle quickly canceled it. This is a kind of a hole, so to speak. It's like a hole here. It's like nothing has happened here. Price went down and quickly closed with the same size of the candle, same movement. It's like nothing has happened. That's how you will interpret this. Same candle, the inverse candle, the green one took over, exactly the same size, bullish engulfment, cancel it. It's like a hole. If we did have a 3 or 4 candle before we reach this level, we may not say this is a hole. This is another hole here. If you see the same size of the candle, canceling it is like a hole. All right. So though the profit taking went 100%, there was a bullish candle that quickly pushed the price back to this point. All right. Look what's happened. Then the price went down a bit after it came back with the green candle here. Can you see? Zooming into the chart. Okay. Can you see it? Okay. After this green candle, the price went down again. In fact, it went back down to this level, but quickly closed up. But look, the two red candle here, it went down and then changed direction here. So we can move. This is another hotspot trading zone because the price changed direction here. So though the price went 100% first, I can explain to you why the price went 100% first. The smart money is very serious to buy at the best place. This candle here shouldn't bring the price all the way here, but the smart money want to buy at the best place. Brokers want to give the best price for their clients. Price go back to the same level where it started to move from to give 100% retracement, even went down below it a bit. These are smart money want to buy at the best price, where there is a value. Though they want to buy, they don't want to buy here straight away. They want to buy at the best place. Very often, a lot of traders get into trouble because with the price going down, the price looking for a better support level. Though the price was at a support level where it's this black line first, even this level here, you can see this candle here. See these candles here. There is a support in this zone. The price can perfectly change direction here, but the smart money does not want to buy here. They prefer to buy here. Price must go to the best place before changing direction. So though now we see that it was a distortion. In fact, I will highlight it because it is a distortion. Because the size of the two candles is almost the same. It's a kind of a hole, so to speak. All right. Moment, please. So I'm calling this bullish engulfment, like a kind of a hole here. Is in fact a distortion, which I'm going to highlight into red. All right. This is a distortion. These two candles here is a distortion. But look what's happened. The price went back down a bit, only to change direction here, forming nicely for us the XA. So now we can say when we are here that there is no more 100% profit taking. The 100% profit taking was a distortion. Now it's like the market itself has rectified itself, bringing the price to the correct price where it did change direction, and this time we can say that this is not 100% retracement. So we can label this point X and this point A. Price move up fast, the dominant force is bullish. Now the bull has taken profit, not 100% this time as it was here, not 100% this time to this point. We will label this point X for X-ray, this point A for alpha. Game on. Though the first attempt was distorted, we have seen that the market itself has rectified this. You will see this very often when the pattern is distorted. Sometimes the market will rectify the pattern. But you want to understand also that when you see a candle going, two candles of the same size going in the opposite direction, it's a kind of a hole here. This is another hole here, almost the same. You see on the same time frame. Okay, when you see that on the same time frame, if it was like a free candle grain to come back here, it's not a hole. All right, pay attention. So we will label this one X, this one A. Now we will expect, talking about Fibonacci pattern, another move from here, somewhere up here, as it was going up. We will be thinking of that it should be between 38.2 and 88.6% of XA. That's the first thing coming to our mind. So we draw all this level, the 50%, the 61.8, the 78.6%, and the 88.6%. We do not assume anything until the price itself or changing direction, trend line is broken, or price came out of the bullish channel. That's how you know. Do not just sell because the price touches the Fibonacci level, but you will sell when the price come out of a channel and retested the channel, at least come out of the channel. Here it came out of the channel, right here. Though you cannot see on the monthly chart, you can switch to, for instance, daily chart, and you will see that it came out of the channel here, or another time frame. All right, so we will expect, this is A, we'll expect A to be between 38.2 and 88.6%, okay, somewhere there, okay, for the SA. Let's measure how much the A to be, okay, went up, okay. It went up to the 88.6%. You see the shadow on top of the red candle. See the shadow here, okay, the antenna, as I like to call it myself. You see, it went up to the 88%, even above it, even almost 100%. But you pay attention to the closing, okay. See the opening price, because this is in fact a red candle. But watch, you see the body of the candle, okay, the top of the body of the candle this time, you see, is near the 78.6%. The 78.6 is this level here. We are talking about the body, paying attention to the body instead of paying attention to the shadow or the wick or the tail of the candle. All right, the 78.6, looking on our left hand side, you see that almost here, you see the body of these two candles also is exactly at 78.6%. In fact, I'm using 78 here. I'm using 78%. I don't use 78.6. I just use 78. Right here is 78%. All right, but I'm talking about 78.6. Okay, that zone is resistance, same resistance zone. You see the body of these two candles also. Okay, same zone. All right, 78.6. Though the price went above the 88.6, the bodies are near the top of the body is near this. All right, the 78.6%. So I will give it the 78.6% level. So we will say that price went up, okay, and then dominant force is bullish. Then there was a profit taking, not 100% profit taking. We call this point X, we call this point A for alpha. The A to B is now 78.6%, though it went up more, we will give it, okay, 78.6%. the first Fibonacci pattern that is coming to our mind when we are talking about 78.6% for the A to B in relation to the XA is the butterfly pattern. Good. Let's move on. So we will expect the B to C, which is in fact down to this level, to be between 38.2 and 88.6% of A to B. But look, it went below the 100%. They bring it down completely. We will say to ourselves, why kind of B to C this one? It's a kind of distortion again. So all we will do, we will highlight, okay, the distortion. All right? So we will say to ourselves, we were expecting it, all right, to be between 38.2 and 88.6. This is the reality of the market, talking about the theory and the messy market. This is why you will first, as a trader, try to understand, try to be flexible, okay, and know exactly what the price is communicating to us and who are the market participants. You want to know. There are many hedge funds in the market trading for their client, and they are very serious, and they will not buy anywhere because there is a signal. They want to buy at the best price and also at the best place. Look what's happened. There was this hotspot trading zone. Then there was the same hotspot trading zone, validation of this level as a valid support level for the third time. Instead of changing direction here, as I'm going to explain it to you now, they brought it back to the same level to buy again. In the mind of traders are thinking of a consolidation taking place in this zone. This is about the market patterns. So they brought, instead of stopping here, they say, no, this is a consolidation taking place here. We wanted to bring it back down to the base of the consolidation. There are only three channels: rising channel, declining channel, and horizontal channel. Here, traders are, this is the best pattern for swing trading. So swing traders, okay, didn't know anything about Fibonacci pattern. They were just swinging it in the horizontal channel, brought it back to this level. As I explained to you, you see the size of the red candle and the size of the green candle is also a distortion. The green candle betrayed this candle by cancelling completely like this. In fact, traders closed their trade here because these are consolidation traders, swing traders. All of them closed their trade here, start buying straight away. Boom, the price went back up. Okay, but talking about the structure of these two candles, we can call this zone as a whole. In this case, if the market confirmed that it was a whole by displaying on the side a new hotspot running zone. Same thing has happened here. The same thing is happening again here. You see, distortion, correction. Okay, market rectified. It's amazing. You don't see it sometimes like this, but this is gorgeous, because if we did not have it like this, you may be thinking, what is George talking about? Whole. All right, but now the market confirming straight away here. See, by giving us, okay, the right place, moving the price back, price return back here. You see, same thing, change direction. So instead of putting our B to C here, in this point in time, we will say there is no B to C, so there is no Fibonacci pattern. But look, game on. The game on again. It's not 100% when we count it to this point, because the price changing direction here. We will remove, okay, moment please. I will remove the distortion on this chart. All right, and we will say now game on. So we want to know, all right, the retracement of B to C in relation to, okay, A, B. All right, I'm going to color this line into red. Okay, so price went up. Okay, then there was a profit taking, which we label XA. Then we have A to B, which is 78.6% of XA. The first Fibonacci pattern that's coming to our mind is a butterfly pattern. The B to C, which is this one from here to here, should be between 38.2 and 88.6%. All right, of AB. Now I will use my Fibonacci drawing tool to measure how far the B to C went down. Now right here, All right, that's exactly 78%. Okay, talking about 78.6% Fibonacci retracement level. It's a valid BC for the butterfly pattern. All right, good. Things are working perfectly for us. Though we have a distortion here, and again a distortion here, the market itself has rectified. This is like a Fibonacci trader say, no, you can't mess up our pattern for us. Game on, you see. It's a kind of fight here, but you can understand that traders that are swing traders that were trading, they were trading a balanced market or a consolidation market right here. All right, but the two candles here has betrayed that there was a distortion here. Again here, it's a hole, and the price itself has confirmed that there was a distortion. Truly, there was a distortion here. Sometimes the small money want to buy the best place. The price must go to the best place before changing direction. We are not alone in the market. There are other market participants, especially many hedge funds that got billions in their disposal, trading for their client. If they want to buy, they will not buy here. They will prefer to buy at the best place. Validation of support and resistance level is the key to successful trading because you are trading with the smart money. All right. So now we have A, B, C. For the butterfly pattern, we will expect, all right? Not we will impose, but we will expect. Not that we will enforce, but we will expect. If it's happening, we'll take advantage of it. If it didn't happen, well, there's nothing for us, all right? We don't want to force it, okay? We don't want to force it. All right? So, we will expect the C to D to go first target 127. This is the line that I'm drawing here. I'll color it into red. That's the first target zone. There are other target zones for the butterfly. It can go to 138. Good, which I'm going to color now into blue. This is the problem when they are trading Fibonacci. They say it must stop exactly at 127, otherwise it's not. That's the theory. That's the theory. You see that the price came to the target zone at 127. Conservative traders will take profit here. They will say that the bad pattern is completed. Now we will draw the warning line. This is another mistake, so you take profit. Some trader will take profit and they will sell straight away and say it will definitely come down and the price will go up as it did here. You will draw your horizontal line, that's your warning line, which means if it goes above the red line and find a support, game on. If you are not truly bullish, you will be cautiously bullish, which means you switch into day trading mode, taking profit consistently because you don't believe that it should go above this level, so you want to be careful if you are buying. It's a psychological mind game because suppose you are bearish, okay, and you see a bullish signal, you take it and you lose. Okay, that's a double blow, all right? You lose because, in fact, first you want to sell, but then you see a bullish signal and then you buy. Now you lose. Now you feel sorry for yourself because you say, yes, I knew it's going to go down. Why did I sell? And you are bitterly sorry. But that's why you draw a warning line and you are cautious because in your mind, it's all about the mind. It's all about the trading style. This is why we see all the time some traders are day traders. They can't use a swing trading system. Some traders are swing traders. They can't use a day trading system. Some traders are long-term traders, and they want the best long-term trading system. It's all about the style of the trader. I do not interfere with the trading style of a trader. My goal is to guide traders. I'll stay out of their trading style, and they develop their own trading style. It's very, very important. Now, we see here, so we will say to ourselves, target zone. In fact, myself, I will take profit. But as the price was going up here, if you receive a bullish signal here, we will take it. The first target zone is the first and nearer resistance level, this one. It's not 127, it's the first and nearer resistance level. This is about conservative trading. You will draw a line here because there's a resistance here. If you break above it, as he did here, you will be cautious because there's another resistance here. Sometimes trader will say, it will definitely go to 127, and it didn't. And sometimes you see a winning trade become a losing trade. It's your money. Manage it and enjoy. All right. Manage it, enjoy. All right. So step by step. First target zone, second target zone. The theory say 1 to 7. It may not go there. This time it went there. Sometimes it may not. It may not, which means we see another consolidation taking place, blah, 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 okay? So, step by step, all right? The important thing that, okay, you keep adding to your trading account and you minimize, okay, your losses, all right? All right, that's what you want to do, step by step. Building your ability to trade, no rush, all right? So now our target is hit here. We draw the warning line. We don't just force to sell it. If you receive a signal here to sell and signal fell, come out. Because if you go back to the red one, just close it. All right? So next target, 138. It went above it. The price, in fact, went to the 161% Fibonacci extension zone. Color it in pink. You see, that's zone. All right? 161%. It didn't stop at 127, didn't stop at 138, it went there. It can even continue to go to 200% or 261% or 314% zone. Nothing. If the fundamentals are sound, if the market sentiment is bullish, if we are in a bigger bullish cycle, this okay, currency pair, which traders use for carry trades, okay, Australian yen, is a very, very difficult okay, financial instrument to sell because the market always tries, because of the okay, interest rate difference between Australia and okay, Japan, all right? Because the interest rate in Japan was high and in Japan was low. At that, in the last decade was very, very low, and in Australia, okay, the interest rate was quite high. So trader was trading this carry trade, okay, Australian yen. During that time, okay, they were all buying, okay. But as you can see, a pattern now is completed. But it was not easy because the pattern was distorted. By finally, we have filtered out, okay, the distorted pattern and clearly recognize, okay, the butterfly pattern. As you can see, ladies and gentlemen, we want to work with what we call, okay, stable data, guidelines, things that remain intact in the market. As you can see, we want price going in one direction and then a profit taking, not 100% profit taking. If we see 100% profit taking, as we see here, we will highlight it. We will understand also that smart money always want to buy either double top, double bottom, at the best place. We will highlight it. But we do not assume anything. We take only valid signal. We see if the market itself revealed to us that it's a distortion, game on. Same thing has happened here. Right, it is again, it went up, game on. But the most important thing when we are talking about recognizing a valid pattern is about trading. When we are trading, what's the first thing that we do? We look for a high probability a trade, a setup. If the pattern is not high probability trade setup, we are not interested. I mean, but if you want to play, you want to play it carefully. All right? So you know the risk, but you say, all right, let's give it a shot. All right? But you know what you are doing yourself, consciously. You will not call your mother for that if it ends up being a losing trade because you take, okay, a calculated risk. All right? This is about learning to trade, understanding the market, and adopting the mindset of a professional trader instead of just getting excited and jumping into the market anyhow. I'm saying this because it is very, very important. All right? Okay, so we look first for the high probability trade setup, which usually you will see either on a daily chart, weekly chart, monthly chart, quarterly chart, yearly chart. If you can see 3 years chart, we will look at it. All right? Then we will look for a signal, wait for a signal. The signal, if the setup is not high probability trades setup, but you receive a signal, do not take the signal because the setup should be high probability setup. All right? High probability setup. And then, if you receive a signal, you will take it. The signal time frame should be different from the entry time frame, because you are about to enter the trade. You don't want to enter the trade somewhere and then lose first, only to see the price going, okay, exactly where you expect it to. The entry time frame is very important because it allows traders to pinpoint their low risk entry point. Let me say this again: low risk entry point. It's not because you want to buy. You see the smart money, what the smart money did here, though they know that the price should change direction somewhere here as the Fibonacci. You see the tail for this monthly, but people were buying here. Fibonacci traders were buying here. The smart money say, hold on a second, we know, but we don't want to be taken out of our trade like you. We want to buy at the best support level. That's what they did here. Same thing they did again here. They knew that some traders understood. You see, this time they say, well, they push it down here before, they would like to buy here again. Everybody say, yeah, let's bring it here. We don't want this mess as we see here before. We lost money here before. We don't want to lose money again. And everybody bring it back again here. All right. So getting into the same discussion with other traders and try to, okay, play the low risk, okay, strategy. Okay. So they set up first, then the signal, and then the entry point. This is about the TSDW S008 trading system. Find first the valid setup. If the setup is distorted, if the pattern is distorted, go follow the guidelines. Price went down, profit taking. We don't want 100% profit taking. Good. If it's not 100% profit taking, we label it SA, according to the guidelines that we use to recognize a Fibonacci pattern. Next, A to B should be between 38.2 and 88.6% Fibonacci retracement level of SA. Very often, you will see that the A to B can be 100%, even go below it, because of the smart money, or sometimes the market is not very, very excited about the financial instrument and they want to take a careful risk, so you will not see, okay, you can go 100% straight away. Highlight it if you see that. See, just highlight it like I did now in red, like a distortion, kind of distortion. Say, okay, give it a chance. Let's watch what's going to happen. Take signal, draw your channels, and watch it step by step. All right. And as I did here, you will slowly but gradually, okay, filter out the distorted pattern. Sometimes there is a game in this market when one group of traders will distort another pattern to fool other traders. Instead of the price stopping exactly at the key level as people were expecting it, they probably violate the theory. This is about the reality of the market. And traders that are religious about their theory will be confused, or they will miss excellent opportunity. Like here, few traders will know now that we are in a target zone. This is a target zone, so what we call convergent signal. What do we do? How do we trade in this zone? We see a kind of, this candle is not yet completed because this is a February candle, it's not yet completed. So we'll wait till the end of February and see what is happening for this monthly candle. How do we trade this? Go and draw your channel. I will go, for instance, to the 4-hour chart, a very crowded time frame, and start drawing channel. I know something that is stable in this market. The price going either in a rising channel or in a declining channel or in a horizontal channel. That phenomenon does not change. It's always the same. It's always the same. It's happening day in, day out. So if I want to sell, I want the price to come out of the rising channel at least. On this 4-hour chart, if I extend my blue trend line, you can see that the price is still above, okay? It's still inside the rising channel, the blue channel. Okay, maybe I can color it in a different color. Maybe you can see it better on your chart. Let's use green. All right? All right? All right, let's use green. Okay, where are we? Still in the channel? Yes or no? It's still in the channel. Good. Okay, still in the channel. What do? Draw the median line of the channel. Okay, now we draw the median line of the channel. The price now below the median line of the channel. Okay, I'll use orange. Can you see orange? Yes, good. You see now? So, and also we draw trend lines. Okay. Sometimes the price may be in the channel, but there will be a channel. Okay. So if, like now, there was a top, another top. If you want to sell it, but it's better to wait for the month of February to close first, so we can analyze clearly what is taking place. Okay, in this. Okay. market for this Australian dollar-yen currency pair. Before I close this video, it's very important that I mention to traders, okay, the importance of the trading triangle, the market first, the sector before the individual financial instrument. Many traders can trade, but they do not use the trading triangle when they are making their trading decision. And the economy news, the fundamentals, the market leaders, the market indicator are messing their trade day in, day out. Talking about yen, what's happening? The Japanese government is intervening in the market to devalue the yen. That's the truth. And the hedge funds are selling the yen. So, a lot of traders are buying anything, currency pair that is connected to Australian yen. They are buying everything because they think that the Japanese government said it clearly many times that they want to devalue their currency. You need to be careful because these are market participants also, but also a powerful market participant. They can come out and speak and mess up a trade. They can come out and intervene in the market and mess up a beautiful technical setup. We must always pay attention to the economy news. It does not mean that you will hear traders say that I'm a technical trader. I've seen hedge fund traders say I use only technical. What they mean is this, that they do not trade the fundamentals. They trade the price, but they know when a news, okay, a very important news will be released. They know. They know what sort of market participants will use the news, how they use the news. They understand it. They also know the impact that the news will have, okay, on the market. They do not disregard the news. Though they say that they are technical traders, they pay attention to the news. The difference is that they do not trade the news. They do not go and do a fundamental analysis. But they are aware of it. They know how it will impact on the market, but they take low-risk trades and they make profits because they do not disregard fundamental traders or the news or anything else. Or you may hear somebody who is alien practitioner will tell you that I do not use fundamental, but I use only technical. At the same time, these people do not disregard the news. They are aware of it. They know when it's going to release. They know when the non-farm payroll will be released. They know when the crude oil is due. And they play their game carefully so they can make excellent decisions. I've said enough. That's it. Thank you for watching. And until the next time, enjoy yourself and be very happy. We are the TSTW SYS008 traders. Until the next time, enjoy yourself.